look at your portfolio like you just put everything on that day. And he says if he's ever in a situation where he's not sure, first thing he does is cut it in half. The majority of times people have early failures rather than early success. Becoming a great trader in many cases is the ability to have enough self-confidence and resilience to be able to take that complete failure and learn from it. There's a Wall Street saying that goes something like this, that even a poor system can make money with good money management. It's probably one of the most stupid things ever said about investing.
For every rule, there's times where it can be broken.
It takes a lot of discipline to not trade when there isn't an opportunity.
Risk management can be put on the page, and it could be even less than the page. The last thing you define is the size of the position. The position size is defined by the risk level that you're taking.
So Matt, today we've got 13 clips and we're going to talk about lessons from our 2 interviews with Jack Schwager.
Let's do some Jack Schwager. I'm so in for this. I love Jack's work so much.
Yeah, and one of the things we hear, we're a long-term investors podcast, and one of the things we hear when we have people like Jack Schwager on is like, what are you guys doing with trading? Like that doesn't really relate. But hopefully what we're going to be able to show today is a lot of the same rules that these great traders applied can also be applied to a long-term investor's portfolio.
One of my biggest takeaways from reading all the Market Wizards books early in my career and just keeping tabs on all the stuff that he puts out there was these feel like they're books just about trading, but they're really books about anywhere you have risk in your life, in your job. I use it in the financial planning context all the time. These are philosophy books, not just trading and execution books, but you can take them in both directions too, which is why I love it so much.
So yeah, we have a standard closing question we ask all of our guests, which is if you could teach one lesson to the average investor, what would it be? The first time we had Jack on, instead of asking that question directly to him, we asked him about some of the greatest traders he's interviewed. So here's his answer about Paul Tudor Jones.
Paul basically believes that you should look at your portfolio like you just put everything on that day. Don't get too complacent because, I've got this position and I'm well ahead. I don't have to worry about it. It's that thing. Question is, if you just put this position on it today, would you be comfortable with it? Or would you be comfortable with it where your risk point is, So having that mentality of not getting complacent and viewing every position, not how is it since you put it on, but how does it look today? Would I want this position at this price with my risk point today? So that's what I would say is, one main lesson I could remember from Paul Tudor Jones.
I think this one has so many implications. So would you put the position on today can be carried to a lot of different levels. So that can apply to a trader. Now, if I'm a long-term investor who holds stocks, would I hold the stocks today? Now, if I'm somebody who has an asset allocation in Vanguard ETFs, would that be my asset allocation today? So I think there's you can take that same question, you can carry it down to all different types of investors.
And we just have to say, like the Paul Tudor Jones contrast collared shirt and red suspenders from the PBS special, that's Jack's flannel shirt, right? I realized that watching this clip. That's really his variation on that masterful piece of fashion advice from PCJ.
I didn't even realize that. That's why we've got you here, Matt.
This is why I'm here. I do think this idea of judging where you are in a decision, like from scratch, is a really useful thing. And that could be anything from saving money into your 401k or whatever else. It gives you that ultra zoomed in, why do I have to keep doing this? It works for any pattern in life or anything that you're assessing. If it makes sense over the long term, you want to keep doing it. If it doesn't make sense over the long term, then just start from scratch and give yourself that permission to have, I think of that Dick Thaler thing on his wall over his desk where he had the no sunk costs, like with the circle and the red line through it. Just don't get hung up on it. Operate this way. Genius thinking.
And this will be the first time I've ever used a behavioral principle right in our podcast, but I believe this is the endowment effect, right? I mean, we value what we own so much more, and we're unlikely to change it because of that.
The endowment effect and sunk cost fallacy all wrapped up into a neat little red suspendered contrast collared bow.
And the only other thing I want to say with this is you do have to be careful about, obviously we can't just change our portfolio to whatever it would be if we started over. Obviously there's taxes and there's other things like that, but I think it's good to keep it out there as kind of like a North Star. Like, here's what I own today. Here's the North Star of what I would like to own. And then subject to all of those other things, maybe over time, I might work myself towards that.
For all of these, it's a philosophical exercise. So it doesn't mean you're literally going to do it. And it's not encouragement to just recklessly change your mind. This is the difference of like eat Wheaties for breakfast, don't drink beer for breakfast. Like, they both have long-term ramifications when you play them out. This is a philosophical way to ask that question about, if I had a blank slate, would I continue doing the thing that I'm currently doing?
So we asked Jack the same question about Steve Cohen, and here's what he said.
Steve Cohen, talking about trading losses. I said, about how do you get out? I said, well, what do you do when there's a position you have on and you just undecided, you're not sure if it's just a short-term move against you or you're wrong. And he says, if he's ever in a situation where he's not sure, first thing he does is cut it in half. And if he's still unsure, a little while later, he cuts it in half again. He says, you know what? Before too long, you don't have a problem anymore. And it's a great piece of advice, really a stupendous piece of advice, in my opinion, because a lot of people become frozen. They can't decide, hey, I get out here, I'm going to sell right at the bottom, and then the market's going to reverse, or I hold on, it's just going to keep on going. And they think like there's just a choice of holding everything or selling everything, and they have a problem realizing that you have a continuum of choices. You could hold anything between 0 and 100%. You don't have to have a 0 and 100. And the decision between 0 and 100 is very difficult. But so one thing to that piece of advice where you're uncertain, get out of something. Just get out of something, and then reevaluate it. So that's as a good general principle is not to do everything at one time. And that works for scaling into positions, scaling out of positions when you're undecided. It's breaking trades into components as opposed to just doing everything 100% one way or the other. That's a really great piece of advice.
So this is another one that I think has a lot of implications for many investors. He's talking about sell half if you're undecided, but I think what it really is make small decisions. And it's not always all in or it's all out. Think about the situation you're in, and maybe there's an in-between you can look at that would be a better solution than all in or all out.
And sometimes action just feels good. There's a reality to this. You might have an intuition that you can't quite scratch, but some small action, to your point, small decisions can just feel good. The markets are selling off aggressively, and you're like, this feels gross. Talking to clients a lot so far in 2025 with this stuff. It's like, this feels crazy. Okay, you know what? We have a tiny bit of cash, or we have a little bit here. Let's go buy something. On a bad day, a tiny action, even if it just moves the needle by the tiniest bit over time, can actually make you psychologically feel a ton better, even if the logic's not there. And of course, if you're Stevie Cohen, I don't know, you avoid insider trading and buy the Mets, right? Like, it works out for some people better.
If you can do it, you might as well, right?
If you can do it, you might as well do it.
And this also definitely applies to, we've been getting some calls recently about like, I want to get out of the market. I'm worried about Trump. And these small decisions can be really key in a situation like that. Maybe sell a little bit or maybe go to a lower risk portfolio. There's things you can do that don't require that binary decision.
That's the key right there. Doesn't have to require it, but those little actions can go a long way. And there's a whole bunch of psychological safety that comes from just saying like, well, I did something and it was in my long-term best interest.
So this next one, people look at these traders in these books and think they're like the greatest traders of all time. And they started from the beginning and they were amazing. And that was almost never the case. They almost always blew up first. So here's Jack talking about failure before success.
If you take all the Market Wizards books together, I'd say for sure, the majority of times people have early failures rather than early success. And so there's a couple of lessons in there. One is that just because you fail in the early years doesn't mean that you're doomed to failure, because a lot of the most successful people actually, in fact, Michael Marcus, who I said before, was the first chapter, the first book. That chapter is fascinating to me, at least, so far as how many times he blew up and didn't give up. So part of it is that happens even to the greatest trade. People become great traders. And the second part of it is that part of becoming a great trader in many cases is the ability to have enough self-confidence and resilience to be able to take that complete failure and learn from it, figure out what you're doing wrong, change, persevere, and come back again. And, get knocked down and come back again.
And this is true of long-term investors too, right? I mean, my first stock I bought was a Canadian garbage company that my uncle's stockbroker had recommended, and it went to zero. This is in college. And as you probably I should have known, the Canadian garbage company was going to zero, but this happens to everyone. And we talked about this with Lindsay Bell, making these mistakes early when you have a little bit of money is so important relative to making them further along when you have a lot of.
There's a cumulative aspect to this too that I think it's under-discussed with this. It's not just about the first thing being the mistake or being the blow up or whatever else. If it's the day of your marathon and you stub your toe and you break your toe or something and now you can't run the race, like that's just, it's unlucky and it doesn't tie back to the skill. If like you twist your ankle or something else on the race and then you learn I got to stretch, and then the next day at the next race and the next week at the next race or whatever, now you're stretched and limber and ready to run and you avoided, stubbing the toe and whatever else. There's ways to build skill through small failures at the beginning of a process. And the idea is that as skill accumulates over time, the size of those failures and those stupid mistakes, it really helps if you work them out early. I didn't buy a small junky garbage stock, but I did definitely buy like a small junky tech stock and had the same experience. And it
That's
can
more
be
exciting. That sounds a lot more fun than the garbage.
I don't know. I kind of envy it. I have this envision of like young Jack going like, I found the ultimate Canadian, cigar butt. I know that wasn't the case,
It was my Facebook. It was going to be my Facebook, my Canadian garbage company. It was going to, like, I probably should have looked at like the addressable market and how big a Canadian garbage company could actually get, but it didn't work out that way for me.
Next time that you get pitched on that, we'll call some of our Canadian friends on the show and get them to set you straight.
So this is another one that he corrected an error a lot of people make, which is they think if you have, you can have a good system to manage things around your edge, even if you don't have a great edge. And so here's Jack talking about the concept of edge.
There's a Wall Street saying that goes something like this, that even a poor system can make money with good money management. I told people, how many of you heard that? I think people raised it. Good. I said, forget it, because it's probably one of the most stupid things ever said about investing. And the reason it's stupid, because if that makes sense, like think about going to Las Vegas and you're going to bet on roulette. Okay. You got $10,000. You want to play roulette, right? And you go to 100 mathematicians and tell them, like, what's my best betting strategy if I'm going to bet on roulette, and they should all give you the same answer. And that is take the whole 10,000 and put it on black or red and win, lose, walk away, because the odds are against you. And the longer you play, the greater the percentage you'll lose. Your highest percentage of winning is on just betting one time. It's still negative, but it'll be depending on whether it's a single zero or double zero wheel. But if it's a single zero, it'll be 2.5% against you. That's your best. Those are your best odds. At least you're close to 50-50. And the longer you play, the more certain. And if you play long enough, you're absolutely guaranteed by the laws of chance to lose. I mean, you have 100% probability of losing if you play roulette long enough. So the point is, if you don't have an edge, the longer you trade, the more absolutely certain it becomes that you will go broke.
And this is very true. And I think it's very important to ask yourself all the time in investing, do I have an edge? And that doesn't mean do you have an edge as a trader. So there's a lot of things long-term, or maybe not long-term, but a lot of things average investors are doing these days. And you can put them in a bucket of something I have an edge or something I don't. So like something I don't would be, if you're trading options, the odds are it's not going to work out for you. If you're day trading, that's probably not going to work out. If you're buying these leverage ETFs, we just talked about this with Andy Constant in our latest episode. Those are things where you do not have an edge. So you can wrap whatever system you want around that. It's probably not going to work out. Good things would be if I'm buying index funds for the long term. Like someone like me would say a good thing is factor investing. These things where the edge is in my favor. So I can wrap systems around those and it works out better. So I think this idea is the behind the scenes edge has to be there first before you can start putting these other systems around it.
First off, we have to get famous enough so that when we do the excess returns U2 interview, I can ask, do you have an edge? And they can just point to the edge and I can fulfill this fantasy of this joke that I have in my brain every single time.
It'll happen for me someday, Matt.
It'll happen for me someday. But second, another one that applies in the rest of life too. So I love like the factor investor piece of this. Can't tell you how many times I talk to somebody and they're, you're working for some giant company and you're getting this big bonus. And I love pointing out when people get a bonus or they, sell a business or a part of a business or something they're tied to and they have this big pile of cash. And it's like, let me remind you, this is bigger than like any return on any single other investment you've ever had. Like there's nothing like when you're distracted by the portfolio value and you're like, should I tweak these two positions? It's like, no, you should probably just go to work and get another one of those bonuses because it trumps all these things. And we got to remember that the edge might not be in trading. The edge might just be in the activity that gets you the money into net savings that ends up in the portfolio. And that's okay too. There's lots of edges in life. and you got to put them on in size. Another philosophical reality of Schwager's words here.
So The Market Wizards is probably one of the best investing books wrote of all time, but I think a lot of people maybe get the wrong message from it. So here's Jack talking about how he's equipped to be a trader.
I wasn't a good trader. I mean, I never really was able to go anywhere real further, nor did I take the time to do it. So it never became, and yeah, this is the other thing. It's not just, it's that when you really get down to it, if I was honest with myself, I didn't really net enjoy trading, because for me, when I was losing, and it's probably true for a lot of people, it was way more painful than it was making. And when I made money, I didn't really, it didn't give me a great joy. It didn't add a lot to my life. But when I lost, it really made me miserable. So the equation, by my very nature, I didn't have the attitude that I see in a lot of great traders who they can lose money and they're immune to it. They kind of could take it because they know it's just part of the process. I didn't my instincts just didn't work that's just who I am. So I just never felt that, hey, this is something I'm going to be. Yeah. And that was fine. It was fine. So I've always traded a little bit on and off. Sometimes I don't trade at all. Sometimes I trade a little bit. So it's like a little hobby that when it's working okay, you do it. And that's why it's not everything. So if I start losing money, I stop trading.
So I think this is really important, because most people are like, I read the Market Wizards book. I'm going to be the next great trader. I've got my system. I've got my multiple screens. Let's go. And the person who actually wrote the book drew the exact opposite conclusion from it. I think there's probably a lesson in there.
Is the lesson, did we ever ask him how many trading screens he has? I mean, the guy might only be working off. It could be a laptop screen alone, and that might be what's holding him back.
It didn't seem like, from what he told you, he was doing much trading at all. It seems like he has accepted he can't do that. I don't know if that was right or not, but it seemed like that's what he's saying.
My takeaway from this, when I was talking to him, and I had this thought afterwards, as a lover of, again, like the entire Market Wizards series and somebody who's learned a great deal from them, I was like, holy crap, Jack Schwager saying he can't do this. In a way, Jack Schwager is basically like the Lester Bangs of finance. And Lester Bangs, I'm assuming, is not a household name for you, Jack.
It is not. I'm just hoping this is not somebody everybody listening is going to know. And okay, good.
No, the movie Almost Famous, if you saw Almost Famous, about like the fictitious rock band and whatever.
I did,
Lester Bangs.
A long time ago, but I did see it, yeah.
There's a bunch of Lester Bangs influences in that movie. But Lester Bangs is an iconic rock journalist. And he wrote these really just over-the-top essays and descriptions of different bands and artists and whatever else. But at the end of the day, like, he was never a successful rock musician. He was just a good critic with a very, let's just say, poetic way of explaining all sorts of debauchery and things from the scene. Jack's kind of the same way. He's like, no, I'm never going to be the rock star. I'm never going to be on that level. But I'm a great appreciator, curator, and communicator of those ideas. And it serves just a tremendous value to all of those around us in the industry who, you know, me and you both, I know we're going to get those 18 monitors and make those trades someday. But in the meantime, this is how we're spending our human capital.
By the way, just as an aside on me not knowing the music, my son and I play this game on Alexa where you do it's like a quiz where you get 5 songs and you have to name the 5 songs and the artists from the 80s. And I was so excited today because I had 4 out of 5 and then I got the last one wrong and I'm like, Matt's going to kill me. Like, it was a System of a Down song and like I just didn't know it. I'm like, Matt would have gotten it in 2 seconds. I don't remember which one it was, but
from the 80s though?
It said the 80s, yeah. Is that the 90s?
That would have been 90s, if not.
Maybe it was probably the 90s. I probably have that wrong too. But yeah, I was on a hot streak, and then I did beat the online player I was playing against. But still,
you've dominated children and online bots. I mean, can you ask for anything more? You are the George Soros of that game in my heart, Jack Schwager.
Thank you, Matt. I appreciate it. I appreciate the compliment. So this next one applies to all investors as well, which is this idea that a lot of people think these traders have one strategy. They stick with that strategy throughout their whole career and it always works. And that's not the case. So here's Jack talking about that.
Yeah. People may have an edge in a certain way, but then the markets change and they have to change and you have to change with it. So, so edges aren't constant. The edge, sometimes an edge can be a constant, like in a way that somebody has a really good instinct for markets and, the way they look at charts and the way they interpret the way the market reacts to whatever. They just have these there's just natural traders, and that edge may stay there, even if markets change in a way. But sometimes the edge is dependent upon the nature of the market. Uh, so I think that there was only one systematic trader in this last was it book. It was one guy was purely everybody was discretionary, but one guy was purely systematic. But in his case, what was interesting was that he started out with an approach and it had an edge, and he was kind of making money, almost every, not every month, but he was making money every year and doing well. And then all of a sudden, after about 5 years of doing this, well, he hits like these month after month and starts losing money. And Cohen says himself that it must be because the markets are becoming faster. And he was trading at the end of the day. He now has to anticipate it to change the system and everything else. And it became profitable again. And a couple of times in his career, he had to change the system like that. Well,
This is something I've had to see in my career a lot, as a factor investor. You do have to look, with the price to book ratio comes to mind. A lot of times we're using something, even though we're using a long-term strategy, something we're using doesn't work. And then you have to ask yourself this question. Is this just a period where it didn't work like all the other periods, or is this some sort of long-term problem? And this is one of the most difficult things to do, I would assume, as a trader or as any type of investor. When something's not working, do I still believe in it? Is it still going to work going forward? It's a really hard thing to do, but a lot of these guys did have to pivot their strategy. So they did have to draw that conclusion. This thing that's been working for me for a long time is not working. I'm going to make a change. It's a really hard thing to do.
The meta lesson that there is nothing in life, let alone should you expect anything in markets, that has stayed constant over time. Like, think about, I don't know, the Sears catalog from our youth growing up when it was already kind of like tired. It wasn't the Sears catalog of the 50s and 60s and 70s. And then in like the 80s, it was still like a great place. But, by the 90s, by the advent of the internet, the thing was dead. And not long after, Sears, the empire, was basically dead. The world goes through these like phases, and we have to embrace that certain ideas, certain business strategies, certain things just work for the time they're going to work, and then they die basically on the vine. So any great trader should similarly look at what they're doing. If they figured out something that's profitable for a while, you got to kind of like live in fear. The world is going to move on without you if you can't figure out how to move on with the world. It seems so obvious when you step back and look at it, but it is so damn hard in the moment. And my heart goes out to, like the quant value guys, where it's, if you can embrace the philosophical principles of this, I still believe you. But if all you did was hang your hat on, price to book or something, this is the pain you are dealt to feel. This is the Sears catalog against Amazon.
And just as an aside, that song thing was definitely from the 90s, because I remember the right answers were like Britney Spears, Backstreet Boys, and Rage Against the Machine. So I think that is all.
Did you guess Rage?
Stuff.
Is that what happened?
I got that one right. Yeah.
Okay.
So I was impressed. I might not seem like a Rage Against the Machine guy, Matt, but you never know.
Listen, Jack. F you. I will do what you tell me on this next one.
That was the song, I think. I believe that was the song.
Let's go kill in the name of Jack Schwager.
So this next one is really interesting to me because as a quant investor, a lot of people think one of the big advantages of quant investing is that it eliminates emotion. So it's better for investors from an emotional standpoint. And that wasn't the case for Jack. So here's him talking about that.
It's very difficult, because you have to, and it's always, how do you know, especially for systematic traders, even worse for trend following systematic traders, because by its nature, if you're going to allow trends to work, you have to take a while, you're going to have drawdowns, large drawdowns as intrinsic to that approach. And how do you differentiate when a drawdown is like the system's not working anymore to where it's just a normal correction? So it's a difficult thing. And for one point in my career, I had switched to systematic trading and trend-oriented trading because I wanted to take the emotion out of trading. And I eventually discovered that actually I wasn't comfortable with doing it, because actually it was more because you have to kind of abandon your own controls to let the system do it. And you have to be willing to ride these drawdowns without profound interfering. And I found that much more difficult than just being able to say, I'm making this pressure decision, and I'm going to risk this much. I'm getting half of those there, and I know what my worst case loss is. And I found, oddly enough, that type of discretionary trading took far less emotional toll than did systematic trade, for me at least. So, and the irony is, I did it because I thought it would be less emotional, and it ended up being more.
This comes down to the idea that you have to believe in your strategy, I think. And for him, a quant strategy was actually more emotional than a discretionary strategy, because he believed more in the discretionary strategy and he was questioning this quant strategy when it wasn't working. And so I just think that's an important lesson, because we always think there's these hard and fast rules, quant strategies are better emotionally, but that's not always the case.
So I wrote down this quote just the other day, and I've been thinking about this a lot lately. did you ever become, we're moving now from 90s pop trivia to like early 2000s pop trivia. Were you a Friday Night Lights guy? Did you get into the show in the early
I did for a long
2010s?
time. Yeah, I didn't make it all the way to the end, I think, because there were many seasons. But
5 seasons apparently, which now you have
yeah,
to
yeah.
buy.
I was gone by the end, but that was a tremendous show in its prime.
So my wife and I just rewatched the first season of it, and we'll see how far we get into the later seasons. I had never gone past the first season. Loved the book. So it's somewhere in season 1, and it's Coach Taylor, and I wrote this down because it's so good. He says every man at some point in his life is going to lose a battle. He's going to fight, and he is going to lose. But what makes him a man is that in the midst of that battle, he does not lose himself. I feel like this is that whole thing. This is Jack Schwager figuring it out. Like, I actually kind of need to be discretionary. I am not hardwired to be like a pure quant guy. If he loses that in himself, he just makes himself miserable trying to implement this thing and probably loses a bunch of money in the fact of doing it. But stepping back and saying like, okay, I've lost trying this thing out, but I'm not going to lose myself. I'm going to figure out what it is and stick to my DNA. Clear eyes, full hearts, Jack. Clear eyes, full hearts.
Can't lose, right?
That's
Little
right.
epsilon theory there.
The left slide theory too.
But it's also good. Like, I think it's great that he wrote these books. He interviewed all these traders, and it led to him being more honest with himself. You know, he could have easily gone the other direction. Like, he realized he's not a trader. He realized he can't follow quant strategies. I think that's great because sometimes when you follow all these people, when you educate yourself on all this stuff, you end up going the wrong direction. He didn't do it. And I think that's cool.
Yeah, exactly. And again, back to like building skill over time through like small failures and stuff that doesn't totally derail you. This is him as the embodiment of that. Here's all these great people he touched directly in his research and writing, and he didn't get caught up on chasing anything that wasn't going to serve him intelligently.
So I hope someday, Matt, I'm going to be able to tell you a similar story to the one that's in this next one. It's probably not likely, but I'll let Jack tell it.
For every rule, there's times where it can be broken. It should be broken, ideally, but it's difficult. You don't want to recommend it because it's not everybody that can do it. But somebody like Druckenmiller, one of his keys to success, and I'm sure he'll tell you the same thing, is that when he was really, really strong in the trade, he would put it on in what would seem to be reckless eyes. So when he was really confident, he would like step on the accelerator. And he gives credit to George Soros as being the influence pushing him in that direction. I think he had a natural inclination towards that, but his experience of working with Soros certainly solidified that. The story I relate to in New Market Wizards is he starts working for Soros, and he goes into Soros's office one day. This is when the Berlin Wall came down. He was very, very bullish on the Deutschmark versus the dollar. And some people, there was at the time, I think there was concern that East Germany would be a drag on, the West German currency economy. And he kind of saw it differently. He saw that this was a time, opportunity. And so he's very bullish on the theme mark. He goes into Soros's office describing his idea. Soros asks him, well, how much money do you have on him? He says $1 billion. And George says to him dismissively, $1 billion, you call that a position? The implication being, if you're so bullish, why do you only $1 billion? So that's kind of the mentality. So yeah, there are definitely situations where the standard rule doesn't apply, but this is not applicable to most people. I mean, let's face it, 99.999% of the people out there are not going to be Stanley Druckenmiller in terms of trading talent.
$1 billion. That's no position at all, right?
No. And this is why they call you Jack Reckless Size Forehand, in our circles.
I'm all in on a regular basis, Matt, as you know.
That's right. Well, what do you think about this? Is there what's the most, have you done anything in like reckless size before?
Yeah, I mean, maybe way back in the day. I mean, the garbage company was like most of my, I had a couple grand or so. I didn't have anything, but it was like a huge portion of it. So I guess that was a big thing. But I thought this balance between big bets and risk management for these traders is so interesting, because Jack will talk about, and all the traders will talk about how important risk management is. but they're always like, with a lot of these guys, there are certain situations where they see everything in their favor and they'll kind of throw the risk management a little bit out the window and they'll make the big bet. And like figuring out when to do that differentiated some of these great traders. And I don't have the ability to do it, which is why I will never do that. But I thought that was really interesting, that balance between the two.
Yeah. And the idea that this is where like risk and reward do kind of go hand in hand. Understanding if you truly understand the risk that you're putting on, you can seek greater reward. Now, there's lots of ways idiots like us can get that wrong, but there's also lots of ways where you can point at stuff where, back to this idea, if you know where your edge is, when the right environment shows up to enable that edge in a skillful way, like press that pedal, go all the way in when you're onto something smart. That is really easy to say and really, really hard to do in all walks of life.
So I'm just waiting for the day that I'm going all in on the euro, Matt. It's coming though. Once my system tells me that it's time, I'm going to do it.
Well, you know, all that dollar milkshaking you've been doing, you're ready to bring
Yeah,
all the boys to
exactly.
the yard, I'm sure.
So this next one gets back to our standard closing question. And we asked Jack about what Joel Greenblatt would say. And here's what he said.
Joel Greenblatt, who I interviewed in one of my Coffin Capital, interviewed in one of the books. Oh, I think he quotes Buffett on this. He says, there's no cold strikes in trading. You know, you don't, it's not like you have 3 chances in your round. You can look at as many pitches as you want. So, you know, the point is to wait for the right pitch. And that's, a lot of people have difficulty with that. And in his latest book, like I think somebody like Cameron Sell, and I asked him what the, you know, who worked in a prop shop and saw a lot of traders. I asked him what kind of differentiates the losing traders. And he said a lot of losing traders just, they try to make money every month, which sounds ironic because that sounds like a good thing. Hey, let's try to make money every month. That seems like a good objective. The trouble with that is there could be months, whatever your approach is, there could be months when the market's not giving you any opportunity. And if you're trying to press to make money when there's no opportunity, what you're getting up is losing. And that comes up in a number of interviews. So it takes a lot of discipline to not trade when there isn't an opportunity. That's an important note.
This is another one that has great implications for long-term investors. And the idea is, you know, he talks about the idea of waiting for the fat pitch. But what I really think it is it's about, you don't need to always be doing something. And it's very hard as an investor to just sit there and let your asset allocation work or don't make any changes. And like what Greenblatt's doing by waiting for the fat pitch is he's recognizing that at times he doesn't have to do anything. And at times doing nothing is the right thing to do.
You can't make money every month without an opportunity every month. Like just putting those two things together, like without the opportunity, you're not going to make the money. So you got to right size around the opportunity, not just the outcome itself, the outcome you seek, but the opportunity that creates the potential for that outcome has to be there. And then also, you know, what is it? I don't know, fat pitching stocks, you make the rockin' returns go around. Like there's definitely a theme inside of this that could get a stadium rocking, probably a Mets stadium. Isn't Greenblatt involved in that somehow too? I feel like he might be.
Yeah, I don't know. I'm sure he probably is. So this next one is, again, something that I think is counterintuitive to people, which is people think these traders have these crazy advanced risk management systems, and maybe some of them do, but the key rules of risk management are actually pretty simple. So here's Jack talking about that.
So risk management, people want to make it complicated. People have written whole books on risk management. I think there might be multiple volumes that somebody wrote on risk management. But anyway, yeah, risk management can be put on a page, and it could be even less than a page, and you get most of it. So it's not overly complex. A few simple rules will get you a long way. Now, one we talked about before was no governor's law, no way of getting out before you get in. Now, if you literally do that, you got a big step towards risk management because you're basically deciding when you have complete objectivity before you put on the trade, I'm going to risk, you know, whatever, let's say $100,000. You say, well, I'm going to risk $2,000 on this trade. That's the, you know, so you put on the trade, you determine how far away your stop is. So if you're wrong, that's the most you. So you predetermine assuming you enter the stop, or if you don't enter it physically, you have the mental fortitude to act on it if the market gets there. You basically define ahead of time what your actual loss is. So that's a big step towards risk management. And then there's other elements like, as I mentioned, once look at it from portfolio level. If you did a rule, like I said, you take a small amount of money that you can easily lose, doesn't mean anything. And that's what you start. And you trade as long as you don't exhaust the money, you'll never get hurt because you're never putting up that much. But if it does work, then you start getting ahead and you're in the proverbial words playing with the market's money, but literally doing that. So something like that, it can be very, very effective. Diversifying so you're not just doing everything in one trade is obviously important. But that, if you're always limiting your loss to not too much of a trade, you've already achieved that. So it's not complicated. It's just a matter of doing it and never breaking that rule, because it only takes, you only have to break risk management one time to go break.
This Bruce Kovner quote, I really love it. Know where you're getting out before you get in. And that applies, by the way, that doesn't just apply to a trader. That applies to anything. Like, I can take the rule and say, know under what circumstances I would change my investment strategy before I implement that investment strategy. Because so many people, like, thinking about times like these, we've got tariffs on and off. People want to change their strategies. And if you knew going in, here are the circumstances under which I'm going to make a change, and you stick to that, that can be really important. And that's a rule that can work for investors in addition to traders.
Yeah, and they're simple rules. They don't have to be complicated. You can come up with some very, very simple frameworks. And this goes back to just like part of your investment philosophy, and the best investment philosophy being the one that you can stick to. Well, part of that's this, like the risk management component of that one is the one that you can stick to, which probably means it can boil down to something really, really ultra simple. Like, do I know how I'm going to get out as soon as I'm getting into something? And can I actually answer those two questions at the same time?
And the other thing I liked about this is you only have to break risk management once to go broke, because I think that's so important. And that's kind of the other side of the thing we were talking about with the huge position sizes. For every George Soros there is who made the huge bet and got it right, there's probably a bunch of people we've never heard of who made the huge bet and got it wrong. So you have to keep that in mind when you see these stories of all these successful traders. Other people did the same exact thing and they were wrong about the trade, and we'll never hear about them.
Yeah, Georgie Zeros. Where are you, Georgie Zeros? You're in the comments somewhere pitching us your financial advisor who made you $1 million and isn't registered with anyone, right?
Yeah, exactly. So this next one is a conundrum all of us face as value investors, and Jack talked about it. So here's what he said.
It's true that in most fundamental approaches, or many fundamental approaches, is that you're put in this risk management dilemma, because if nothing changes and your analysis about value is correct, then the more the market goes against you, the better of, assuming, again, important proviso here, assuming nothing has changed, and assuming your analysis is correct. If nothing has changed and your analysis is correct, and the more the market goes against you, the better the trade becomes. And it's kind of that sort of fight, but it's risk management about not letting your losses run itself. So that's a difficult thing, but you have to have the mentality of being willing to stay with that and ultimately come to the other side. Because if you can't take that type of a situation, then value investing won't, no matter what the numbers are, it won't work for you.
This idea, and I do this all the time, this idea as a value investor, if something goes down, your inclination is always, I want to buy more of it. And if it goes up, your inclination is, I want to sell it, I want to get rid of it, I want to reduce my position. And a lot of times that can be wrong. And just an interesting anecdote on that is, as quant investors, one of the things we do is we have a system like we call our tax management turnover system. But what it does is it tries to limit the turnover of our strategies, and it takes the implications of taxes and other things into account. And the effect that has is we end up holding our winners longer than we otherwise would have, and we end up selling our losers quickly. And that actually has enhanced the performance of the strategy. So it's the opposite of what you'd think as a value investor. And it kind of gets away from what I would be doing if I was making the decisions. And that's why it's great to have a quant system. But that's just an example of this idea, like letting the winners run in that case, and maybe not buying more of the losers. That actually has worked out in our favor.
We see this in a lot of, it's amazing how easy some of this stuff gets coded in these direct indexing strategies these days too. This stuff just gets embedded into a process, and it can be systematically very additive if you do it smart. Another piece, and I know it's coming out soon, or it might be out when this is out. We did Bogomil Baranowski and I interviewed Chris Mayer, and he's talking about running a concentrated portfolio. And so in this, like, I think it's an 11 stock portfolio, you deal with some really, really ugly drawdowns from time to time, and more, in many cases, bigger than ones you'd experience in a larger, more diversified portfolio with more holdings. And he had some really, really interesting thoughts about sort of like, handling that and handling those drawdowns and really looking through to see what those underlying businesses are doing and just how often you should do nothing. In his 100 Baggers book, he goes into great detail about talking about these companies where, like, looking at these peak to peak measurements, of, for example, of like even in between drawdowns when they're compounding internally, why you really just don't want to do anything. And that's where most of your returns and most of your money's going to come from. You got to connect it back philosophically to you to make sure you can stick to it. But it goes like a long, long way to understanding, in this case, like, what is value? What does it actually mean to you? And then how are you maximizing it in your favor?
So the impact of technology on trading is an interesting thing because on one hand, people are always the same. And a lot of the types of things that work probably work long-term. But on the other hand, like, there's a whole different series of new strategies that have become available to traders because of technology. So here's Jack talking about that.
What it does is it opens up different opportunities and different, lots of trading strategies that exist today were impossible once they started business. There were no quote machines, there were no charts. There were charts, there were hand-delivered charts that would run once a week that you kept looking at. But there was no intraday data back in those days. So, first of all, just like no intraday data. Everybody who's trading on intraday bars or using intraday information, whether it's by looking at charts or by programming systems using intraday, all of those approaches were impossible back then because the data didn't even exist. There were, lots of fundamental data just didn't exist, it wasn't accessible, that it is now easily available. All sorts of, something like, here's a good example. In Unknown Market Wizards, one of the traders I interviewed was Chris Camillo. I went through my whole career not even conceptualizing that there's anything else other than technical analysis, namely using primarily price and things like that to develop an approach to trade the markets, or using fundamental economic inputs, or some combination of two. I didn't perceive that there was anything outside of those two big segments. Turns out, along comes Chris Camillo, and I titled that chapter "Neither," because that's what it is. He didn't use any technical analysis. He didn't use any fundamental analysis, which to me would have seemed a paradox and impossible years ago. I mean, there is nothing else. What else? Well, turns out that he figured out he could use social media to trade the markets. And there was a perfect example of something that didn't even exist when I started. And here it is as the sole source of the trading strategy of a trader who was extremely profitable using.
Yeah, I thought the social media example is a great example. Like, it's just some things that wouldn't have been possible before are now possible because of that. And some of these great traders have found a way to take advantage of that and maybe find some white space where other traders weren't operating.
This is that Sears catalog versus Amazon thing again. It's just the physical medium coming to your mailbox gets eaten alive by a website you can go where you can buy anything. It's just, as the situation changes, the opportunity set around them changes. And like the social media sentiment indicator thing, these are those time machine ideas that now it makes so much sense. If I had the time machine, I could just go back in time and do this. I go read like Wall Street Bets at the beginning of the pandemic and how much money could I make? It's wild to think about how much this changes in hindsight and then map it back to applying to our world and lives today. Because just look how much technology's changed the stuff you and I do in the last 6 months, let alone the last couple of years, right?
Yeah, and I even think about the option dealer flow stuff. That's always been there, but way more people are using options. And like, that's something I've learned a lot from Brent Kachuba is the idea, like, if I'm a trader, which I'm not, but if I was, there's a lot of stuff going on behind the scenes with these option dealer flows that maybe some people are capitalizing on, like Jen and Brent, and making money with it. But for other investors, it's just good to be aware that they're there.
Yeah. And if without the technology, it's a lot harder for them to do. It's a really interesting angle, and it really it forces the question of what are the tools that I have available to me? What are the tools that others have available? And then are we using them to analyze the same or different opportunity sets? It's always going to be a source of edge, just like it's always a source of business ideas.
So we touched on position sizing, but I thought there were some cool insights in this last one too. So here's Jack when he talked to you talking about position sizing.
Where the professional traders differ from most people is people think, oh, even if they're using risk management, they're thinking of, okay, I'm going to enter the market here, and I'm going to let the trading, whatever their typical size, their typical trade is, let's say $10,000 on a stock purchase or whatever. I'm going to put $10,000 in, and and then they don't think about, well, that's a bad way of putting it. Forget the typical size. Let me rephrase that. They decide they want to buy a market. They're going to buy a certain number of shares, and they want to risk up to a certain point, and whatever that comes out ends up being their risk on the trade. And that's the wrong way. The right way to do it is, okay, you want to buy this market here, and you know where you're going to get out. Well, okay, once you have those 2 points, then you should never be taking, let's say, more than 1 or 2%, whatever the number is, risk of your assets. Then the number of shares you buy is defined by the difference between those 2 prices. So you don't automatically trade a certain, you don't know how much you're going to trade until you know your entry, which is, let's say, now, and the exit, which is where you realize you're wrong, which you hopefully predetermine at the time of entry. You know where you're getting out before you get in. You have those 2 points. You shouldn't risk, let's say, more than 1%, for argument's sake. So that will define the number of shares you buy. So that's the last thing you define is the size of the position. What you asked about, position size is defined by the risk level that you're taking, which should be small.
I like the idea that it's an offshoot of risk management. I like that you sort of start with risk management, and that's what gets you to your position sizing. I thought that was an important insight, and so that's why I wanted to put this clip in there.
I think there's also, beyond the risk management component, is just a good mathematical principle reminder. This is something I run into, especially with DIY investors a lot, where it's, have you or have you not learned to think this way? And anybody who's run money for anybody professionally in any way, shape, or form, it's like the pie always has to add up to 100. Like there's no magical extra pieces. You might have money coming in and money coming out, but like 100% is always 100%. So if I'm going to decide how big something is, it means I have to choose how small something else is at the same time. It's debits and credits. It's basic accounting stuff. But like learning to think that way will change the way that you do risk management, will change the way that you do portfolio allocation, will change the way that you think about like, oh, I have this new exciting idea. Where am I going to get the money to fund that? And then what's the impact relative to everything else? Have you run into this much in designing the strategies you guys made at all? Like with having to help people think through this 100% is 100%, no more, no less?
Not really. And, position sizing, like for us, position sizing is such an easy thing. And I'm kind of thankful for that because ultimately, like it's a really, really hard thing to figure out. So as a quant, we equally weight everything. And a lot of quants do the same thing. And that just makes it so much easier, I think, to take this off because we've had a couple of clips about position sizing here. And it's just really, really hard to figure out the right way to do it. And, it's easy in retrospect to look back and be like, oh, it was great to have a huge position in Google. But like there were other companies similar to Google where it was not good to have a huge position. And so it's just, I think it's a really challenging thing and I'm happy we equally weight stuff so I don't have to deal with it.
Yeah. Which is also a good solution. Like if you don't know what to do, figure out a way that neutralizes that decision, like equal weighting in your strategies.
Exactly. So we got through 13 clips, Matt. We didn't ramble on too much, I think. Yeah, not a bad effort from us.
Small miracles. All the credit in the world goes to Jack Schwager's flannels and his excellent books.
Exactly. Thank you everybody for joining us and we'll see you next time.
Thanks so much for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on YouTube or your favorite podcast platform or leave a review or a comment. We appreciate it.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the participants or their clients.